All right. Thank you, David and Anka, for having me. I always enjoy these presentations and the other speakers as well. I've heard Casey before, and actually we had a podcast together. There's another story to that, but that's for another time. So anyway, we're going to talk about looking at the currency markets and how that relates to trading with stock indexes, kind of a unique approach here. And we're going to look at some proprietary automation where there's no screen watching or babysitting involved with your options trades. We're using pre-built option strategies with automation for your risk and your profit controls. Of course, you can use this to hedge your account, directional trades, non-directional. We're going to look at something very unique, a proprietary strategy. And then we have what we call our one-touch trade alerts. So you're going to want to make sure to see that. We'll do a demo in just a second. So thanks again here for Synergy Traders and Timing Research and TradeOutLoud. Remember, we are speculating. There's always risk when we speculate. And of course, you're trying to make money and there's always risk. So with that said, do take a moment to look at the risk disclosure. It is important. All funds admitted should be risk capital, and past performance is never a guarantee of future results. A little bit about who we are. We are Altivest. Since 1997, we have been a registered introducing brokerage firm. Clearly decades of experience, millions of contracts traded over the years. There's some of us on the trading floor with our S&P 500 options staff, our affiliate brokers did a great job for us. We're registered with the CFTC and the member of the NFA. We're located in California. And we've got a lot of experience doing this, so you don't need to figure any of this out by yourself. Don't be this poor dude here or gal sitting in your basement alone. Use our experience, and that's what we're going to show you. We've been, I guess you could say we're veterans by now. A little bit about myself. I am Erik Gebhard. I've been doing this 30 years. Since 1991, I've been licensed. I'm a co-founder of Altivest. I have my BS in business administration, my degree from the University of Southern California. Perhaps you've seen some of our presentations in the past, just a small sample of various outlets, I guess maybe where you saw us. I got my start way back in mutual funds and annuities. I have my Series 6 and 63 securities licenses. And I currently have my Series 3 and my Series 65 licenses. So real quickly, we're going to talk about, just for a few seconds here, following the US dollar index, a few things that developments here in the last week. The Swiss National Bank, first rate hike in 14 years. ECB had an emergency meeting about incremental easing and making some dovish moves. Italian 10-year yields lost 28 basis points in a day. That's an enormous amount in a day. The Japanese yen continues to crash. So if you're not following all this, that's okay. We're going to kind of boil it down into something real simple, but there's a lot going on in that landscape. Here's the Japanese yen, if you haven't noticed, down over 12% in the last 3 months. Japan is having all sorts of issues with the bond market as well. Anyway, we won't go into that, but here's looking over at Europe. Look at the German PPI has an all-time high, producer price index, and even their CPI is similar to ours, just kind of moving into the stratosphere. And of course, meanwhile, the German stock market by the DAX composite is struggling just like ours. So that all makes sense. But look at this. This is interesting. The US dollar just last week, it was up for the third straight week, 9.4% year to date. And here's what the chart looks like. So nice clean trend, an uptrend there in the US dollar index. That has a lot of ramifications, of course, for trade and interest, everything from interest rates, trade, consumer, you name it, debt financing, servicing, I'm sorry. So anyway, but here's the US dollar correlations. Here's the key correlation. So in the last 15 days, you can see here, it's kind of fuzzy, but it's a negative 0.90 to the S&P 500. Last 30 days, negative 7.2, 7.6, 8.2, and 8.2. So even for the last half a year, there's been that negative or inverse correlation with the dollar index and the S&P 500. So that shouldn't be necessarily a big surprise, but you should be aware of these things when you're looking at the global macro landscape and perhaps sort of looking at your positioning with what you're doing in the stock market. And here's what this looks like on a graph. You have the US dollar index in this blue line, the green uptrend, of course, in relation to the S&P 500, which of course is on a large pullback, to say the least, in bear market territory now. So that's what that looks like on the graph. So we're looking at the US dollar index as an indicator on maybe how you might want to position yourself using stock index options. And we have proprietary automation for trading options. So let's get into that and look at these three barriers for trading. I think we can all kind of relate to most of these. So feel free to chime in and put your comments in there and let me know which ones resonate the most with you. Is there really a less than 1% success rate if you're trying to day trade? Well, maybe. Charles Schwab said over a 6-year period, their most active accounts, traders substantially underperformed a simple low-cost indexed fund. Those who traded the most had the worst returns. Here's a study out of Taiwan. 1% of day traders were able to consistently beat the market. That's over a 15-year period. Out of Brazil, 3% made money, and less than 1% made more than the minimum wage. So that's a good point too. If you're trading, are you even beating the market? But even professionals are struggling. In 2021, 79% of active fund managers underperformed their benchmarks. And over a 10-year period, 86% underperform their benchmarks. So can you look to social media for any help? I don't know if that's a smart idea. Typically, if you want to be popular on social media, that means you're always bullish. You know, the day trading army during the pandemic, it says here, Bloomberg, all those day traders have lost all the money they made in the meme stock era, and they've given back all their gains according to an estimate by Morgan Stanley. So people like this, a guy got $500,000 to trade with, and now he's down 96%. So let's not do that, folks. Maybe we ought to listen to people on TV. I don't know if that's any better. Here's Jim Cramer in March of this year saying the bear market is over. You see the date right here. And of course, here's where he made that comment, and here's where we've been since. So I wouldn't hang my hat on what people on TV are telling you either. So that's called narrative trading, selling a story. A lot of it is fairy tale nonsense, talking your own book, that type of thing, being popular, saying what the audience wants to hear. But even if you are trading, can you beat the market? Are you beating the market? Here's an interesting analysis here. It says here they ran a basically a test with 96 of 100 of these monkey portfolios beating a generic cap-weighted index and outperforming the benchmark by 1.7% per year. So there's your better trader right there. Maybe that creature there is better than all of us. So keep that in mind. And number 3, the emotional aspect of it, very difficult to overcome our human emotions. It can be expensive trying to convince the markets that you are correct. It's from Ed Sequoia, a great book, Market Wizards. Highly recommend that. There's a subsequent follow-up to that too. So don't end up with this on your tombstone. You don't want to argue at the screen. And really, our worst financial enemy is us. That's according to Motley Fool. And I think I would agree with that, even after all these years of doing it. So you end up with all these different biases when you're trading: confirmation, anchoring, recency. So this kind of sums it up, really. When things are going well, we look at what we're doing and we tend to think we're maybe smarter or better than we really are. But algos, of course, don't have that trouble. Machines don't have that issue. And they're dominating the landscape. Algorithmic trading here, 90% of the stock market, according to JPM, is volume based on machine trading, HFT trading, algo trading, whatever you want to call it. So this is really what that looks like. We're over here on this side here of the page, kind of that AI technology now surfacing. Here's what trading used to look like. I won't go into this little grainy video I took years ago, but this is what it looks like now, folks. No emotion, automation, built-in controls, and that's where the volume is. So we're going to look at some automated options technology and some strategies for really any market condition, even non-directional and bearish strategies, which might be handy. Looks like the sell-off in the stock market, at least in our view, is probably not over. But to do this, let's first look at a little bit of context. How do insurance companies exist? Well, we know how they exist and how they do things. They get paid premiums to assume risk, so we pay them, and they're selling time and they're managing time, but they insure themselves by hedging. It's called reinsurance, and they're consistent, they're patient in their business model, and they look at probabilities. They're simply looking at math, favorable numbers, statistics, actuarials, you name it, just quantitative data crunching. So what can we do? Can we apply that same approach with trading options? And the answer is yes. So we'll look at premium collection strategies. So we're looking at base hits, trying to capture premium. We're looking to be consistent and patient. We have to manage our risk, knowing that we're going to have losers. Manage reward, just as important, never getting overly greedy, but you need the proper tools to make this happen. And remember, we're looking for base hits, not these grand slams. So short option strategies for collecting premium, again, non-directional, bullish or bearish. And we'll look at outcomes that have predetermined risk. These are called credit spreads. Every position is insured in advance or when you place it, and everything is predetermined in terms of risk and reward. And you can even be non-directional. You don't have to be bullish or bearish. And why do we look at stock index futures options compared to individual stock options? Well, an index is always less volatile than an individual stock or market. And of course, with an index, you can apply strategies that really have attributes that can relate to your portfolio, perhaps, broader based applications. And then, of course, just one market with an index, maybe we're looking at one or two different indexes rather than 6,000 or 7,000 different stocks and ETFs. So much easier to track. And here's an advantage. There's a wide margin of error on many of these strategies. And don't worry about this chart right now, but all you need to know is, you know, if the market were to stay within this range here in this particular case, then that trade would be successful. So it's a very wide margin of error. And let's jump into the Greeks real quickly. If you know this, it goes quickly. If not, it's simple. The delta. It's basically how much does the value of the option change when the underlying contract changes. But really, the better way to use it for our needs is it's the approximate probability of expiring in the money. So if a delta is 0.25, that means there's a 25% chance that option expires in the money. But conversely, a 75% chance that it expires worthless. Remember, delta is always moving with price and time. It is not static. And this is important. It is not the probability of a winning trade. So keep that in mind as well. And then there's theta. So theta is really a function or relating to time decay. So when you talk about options, remember every option has limited life. And theta is a negative number and it equals 1 day of time decay. So for example, if an option's at 10 points and the theta is negative 0.05, then the next day, all things remaining equal, the premium would drop to 9.95. And the next day after that, 9.90. So there's always theta decay. And this is what it looks like on a graph. You'll see as you approach time 0, the percent of that premium remaining drops and drops and drops till eventually it goes to 0. Here's an example of a call spread. We won't go into every single detail, but you can see here that the red line is the call that we're selling, and you collect 4.5 points for selling it. The blue line is the one that we simultaneously buy as a hedge, and you pay 2.25 points for that. But the net result is you collect 2.25 points, or in this case, $112.50, and you put that in your pocket minus your commissions, of course. And that's basically selling a covered call spread, and that's what that looks like. And then the same thing with a put spread. You can see here the put that you sell and the put that you buy, the red and the blue line. You collect 3, you pay out 1, and that result is you collect 2 points or $100 minus your commission. So that's what those look like, very simple trades. Remember, these are not naked options. If you're doing naked options, I'd highly recommend you don't. Again, doing this over 30 years now, and I've seen clients and other traders and so forth and people in the industry trading very, very successfully for a period of time if they're selling naked options and collecting premium, and it works great until it doesn't. And when it goes wrong in a big way. So you want your maximum risk to be capped in advance. You want to do only covered option spreads, no naked trading like these poor little creatures without any clothing here. And another big advantage when you're doing covered options, there's no margin calls. So if you're trading naked options, you're going to end up having to add more money at times and meet margin calls. The way we do it, there's no margin calls, and that's because there's not unlimited risk. So you don't want the market trading you and jerking you around. You want to be in control of the situation and not have to throw good money after bad and meet margin calls. Here's an iron condor. It's another basically premium collection strategy, and it's simple. It's a combination of the put and the call spread that we just saw, and that's all it is. You sell an out of the money call spread, collect the premium. You sell an out of the money put spread and collect that premium, and you're looking for the underlying market to stay within that range over a period of time. And now here's where we reveal our, I guess you could say, our proprietary strategy, our short option strategy for collecting premium. It's called the Dragonfly. That's the name we crafted years ago. We just thought it was a clever name, and it represents 6 legs to collect option premium, and it's a variation on a Condor. And if it sounds complicated, it is and it isn't, and I'll show you why. And we're going to get into the demo in just a minute. But this is what it looks like. You sell 4 calls, you buy 3 further out of the money calls, and you buy 1 closer to the money call. And the same structure on the put: sell 4, buy 3, and then buy 1. And just to point out, you'll notice the one that you buy here, that's a 40-10 call. That's 50 points closer to the money compared to the 4 that you sold. And the same thing here on the puts. The one that you own is a 32.50, and that's 50 points closer to the money compared to the 4 that you sell. And so really the structure on a Dragonfly is going to be similar to this, although the difference and the variation between the strike prices could also be different. And I'll show you that with our algo. And we have some other unique strategies. We're going to just touch on this quickly for bear markets. You can just do half a Dragonfly and just do the calls. So if the market goes sideways or it decreases, or even if it moves modestly higher, the half Dragonfly call spread could work out just well for you, just fine. So here's what that looks like, that same structure. Remember the 4, 3, 1 we talked about. So just doing half of the Dragonfly. And of course, there's something else. We came up with this name of bear hedge. So you sell an out of the money call spread, you collect the premium for that, and you use that premium to buy an out of the money put spread. And oftentimes you can do this for even money or a credit. So we'll look at that in just a second. But how do you even choose what market to do to trade, or what strike price, or what expiration? How do you come up with an entry point, an exit point? How do you manage everything? Well, that is where Theta Trader comes in, and that's our unique proprietary platform for pre-built options trading. So we have Theta Trades every day that are created by automation, bull, bear, flat market strategies, you name it, and then automated risk and profit tracking. That's very important. So no more babysitting or screen watching. Theta Trader will track and monitor your positions. So we're going to look at that here. Let me switch screens. All right, you are now looking at the Theta Trader dashboard. Let me zoom in here. This is a demo account I use for presentations. So your dashboard would look very, very similar. Wouldn't have some of these features up here, but that's okay. Otherwise, you'll have this section for Theta Trades. You'll have this other section here for your open, short, or sold positions, any open, bought, or long positions here. And then you'll have your account info. This info is connected directly with your AltaVest trading account. And of course, Theta Trader is our platform. It's our technology, and it connects with and works with AltaVest as the brokerage firm. So I want to be clear on that. And then here's your current quote. So first thing we'll do, we'll look at the Theta Trades. You'll see there are bullish strategies that are pre-populated, bearish and neutral. You'll notice the three markets. We're looking at the E-mini S&P 500, the E-mini NASDAQ 100, and the E-mini Russell 2000. And we'll show you why we trade these markets. But for now, we'll just jump right in and look at a Condor. Here's the Theta Trades for today. They have anywhere from 17 to 71 days till expiration. And again, the algorithm has pre-built these strategies for us, these particular trades. And you'll notice here, this is your maximum profit potential at expiration. This is something called the targeted annualized return at expiration. So this number here is really to compare one trade to another. You would not realistically expect to make 249% annualized just by placing this trade. This is just simply to compare one Condor to another. And we'll just drill down on this one. I typically use the trade that has the most time during these demos here. All right, you'll notice here, there's a graph of what the trade looks like, sort of an overhead view. Here's where the market is now. So you're selling this call spread here. That's the 43.50 calls, and you're selling the 31.10 puts. So you can see it's a very, very wide margin of error, big range between the sold puts and the sold calls on the S&P. And we'll look through this table here. I wonder if this zooms in just a little more. How's that, folks? Okay. You have days till expiration up here, settlement. I won't go through every detail. The net premium being collected, your put risk, call risk, commission, available capital, cash required, your maximum potential at expiration. This is something called the targeted return on cash, your TROC, and then your targeted annualized return. I want to point out too, let me show you the puts here that you're selling. They have a delta of 9.86, and we talked about delta, and essentially that means there's over a 90% probability that this option is going to expire out of the money. And look at the call, delta of 6.84. So you have a 93% probability that this call that you're selling to somebody else is going to expire out of the money. So just the math says, you know, the probability of these expiring out of the money is very, very high. And that's why the algorithm has chosen to sell these particular strike prices. And you have the cash of $883. You're putting that up on the trade to make a maximum of 116. And sometimes people will scratch their head and think that's sort of a backwards ratio, but then they kind of forget that we're looking at these outcomes here that have a very, very high probability in terms of the math of success. So that's the difference, folks. It's like, you know, there's some analogies, sort of like the insurance company. As you collect those premiums over a period of time as an insurance company, you know, there's a high likelihood that overall, in the long run, you end up collecting more premiums than you have to pay out in claims. So that's the idea. Then, of course, you could change or modify these strikes if you wanted, but I wouldn't recommend it. I just want to point out that you can do that. It always defaults to a sell. Quantity is defaults to 1. You can see as you move the arrow up, the cash required changes, profit potential changes. We'll just leave the pricing at 2.25 and place that trade for 3 of these Condors. And there it is, just that simple. And the order is placed. All right, now let me show you the Dragonfly. And then we're going to jump into a really great feature. That's the trade simulator. So here is a Dragonfly. And this is the August end of month. The same expiration that we just looked at for the Condor. So here's what the trade looks like. So let's go to the table here. And you'll notice basically the difference is you're selling in quantities ratio of 4. Every time you do a Dragonfly, it's 4 puts and 4 calls. If you did 2 Dragonflies, it would be 8 puts and 8 calls. So of course your cash required is higher. Just approximate that each Dragonfly is about $5,000 in margin. Your profit potential, of course, is higher. The targeted return on cash, targeted annualized return will be a little bit less when you do a Dragonfly, and that would make sense because, again, you pay money to buy this call and this put. So that's a little bit of money out of your pocket to buy an additional insurance to make sure this trade's a little bit more robust, and we'll show that in just a second. And again, you're looking at deltas. The puts here, 9.86 and 6.84 on the calls. So again, over a 90% probability and 93% probability that these puts and calls being sold will expire out of the money. This always defaults to selling a quantity of 1. So you want to run 2 of these. So the cash required is just over 9,000. You're trying to collect 11 points per Dragonfly, and we'll place that order. And there it is. Now, in reality, if you're trading for real, you probably wouldn't do this because you're selling the same strikes on the Condor as you are on the Dragonfly. But of course, this is just a demo account to illustrate the functionality here. So here's a really great feature. You can go backwards in time and really run some scenarios. There's a trade simulator right here, and I've loaded some trades to save time. Let me squeeze this down. All right, so here's an end of month August Iron Condor. Well, you can use these tools here to go forward in time. You can go backward in time. You can go forward 1 step at a time, or you could jump right to the end. But you'll notice as each day goes by here, you can see the P&L is a little bit negative, and that's normal. Theta decay hasn't really worked yet. This is green. I'll show you that in just a second what that means, but it means good, do nothing. You can see the trade is profitable, and then this turns blue. And what does that mean? It means to take profits, and you can automate this so that you can set up your account so that whenever it turns blue to take profits, your order is automatically placed for you. So you do not have to watch and monitor these positions. But that's a typical Condor. Market moves around sideways, maybe moves a little higher, but eventually theta decay works, and that trade turns out to be profitable. Now here's a Dragonfly, and it's the same. Just want to point out here, this is your end of month August. The trade was placed on July 6th. So here you are, July 6th, and you do a Dragonfly for the end of month August. So this is interesting. This turns blue and profitable on, or let's just say it matures enough for the signal to take profits, and it has 28 days remaining. So that's August 4. And if we look back here, you'll see this one on the Condor, you had to wait till August 20 before it matured enough to take profits with the algo-driven signal. So the Condor and the Dragonfly both worked out in this case, but the Dragonfly allowed you to get out about 2 weeks earlier, and it matured much more quickly. So that's a big benefit to a Dragonfly. It can behave much differently compared to a Condor at times. And here's another Condor. This one here, I kind of forget exactly how this ends up, but that's all right. Just see what happens. So you see it's yellow, slightly elevated risk, and the trade is negative, the P&L right now. And then it turns orange, so elevated risk, and then yellow and back to green. So it's getting volatile right there. And then it turns red. So that's a loss when it turns red. So again, you can automate this so that if it turns blue for a profit or red for a loss, whichever occurs first, you'll automatically have that trade closed out for you. So that is a Condor for that March 2020 expiration. So here's the Dragonfly for that same expiration. See, it turns yellow. And look at this, folks. It turned blue, gave you a day, a window of opportunity for this order to be closed out at a profit. So the Dragonfly, again, can behave totally different compared to the Condor. Just depends on market conditions. Of course, it's not always going to survive. Every trade where there's potential for profit is going to have potential for loss. So just want to point out that there can be some unique distinctions between the Dragon and the Condor. Here's the bear hedge we talked about briefly. And remember, I'll stop this here. You're selling an out of the money call spread and you're buying an out of the money put spread. So there you have this bear hedge. And what I wanted to point out, and I think the reason I chose this was if you were just kind of watching this particular trade, you can see how much movement there is. You'd have a tough time figuring out where to get out. But the algorithm here turns blue and would have pulled the plug for you so you could take profits and move on. And had you not done that, you can see here the market then jumped higher. And then, of course, the trade would have expired completely worthless had you not taken profits when you had the opportunity. So that's why it's important to follow these. I think it's important to follow these parameters, use those preset. Here's another trade, a half Dragonfly call spread. And let's look at this one here. It turns profitable with 49 days remaining. So that one worked out just fine. And here's another Iron Condor. I forget exactly how this plays out, but let's find out. So you can see here, it's starting to move. Theta decay is working, but at the same time, it's moving closer to your upper boundary. So the trade's still negative. And then it turns orange, elevated risk. And then it turns red, too much risk, get out. So that trade ends up being a loser, too much volatility there. But we can check in on the Dragonfly. Had you done a Dragonfly on the same day compared to the Condor? And look at that. It actually turned profitable and gave you a chance to close out that position. So there are some distinct differences between the Dragon and the Condor. We love the Dragonfly. We occasionally will do Condors as well. It just depends. But I think the bread and butter for most part should be the Dragonfly. You give up a little bit of profit potential, but at the same time, it tends to be more robust when it's under pressure. And also there are opportunities to have an earlier exit. And again, if you want to do a bear hedge, it's just that simple. They're all loaded here for you, pre-built. So in this case, here's what it looks like. You're selling this out of the money call spread and buying this out of the money put spread. And you can do that actually for a small credit. And, you know, we'll just throw 2 of those in there just for the sake of the demo. And that's how you do it. And then people will sometimes ask, do I have to do a spread? Do I have to do a Condor? Do I have to do a Dragonfly? Can't I just do something a little more simple? Well, yes, you can. And I'll show you that here quite simply. You can see here, you can do just a simple call spread. You could just buy puts if you wanted. These are all pre-selected. You could do butterfly strategy. Those can work great at times, but you kind of have to thread a needle for those to work. You could do something on the Russell, on the NASDAQ. You could do any of these strategies here, pre-formatted. But let me show you real quickly. Our time is limited. This is how you go to the automation. You activate your risk manager and you activate your profit directive by simply clicking here and then apply that to your account. And then once you do that, Theta Trader will now be scanning your account. And anytime there's a blue or a red RTI, it will automatically place those orders for you to close out those trades. So that's a really, really great feature for automating and removing your emotions. That's really the point of it. We put that together after years and years of trading with, thousands of clients trading millions of options. So a lot of thought went into this to simplify it and make it effective. Here's all the color coding for the RTI. People sometimes ask about that, so it's all in here. There's also video tutorials. There's video education. It's all part of Theta Trader here. And we also have daily research. That's our proprietary research. This is called TradeScope. A little bit more of a chart analysis tool, and then a market outlook as we go forward and what kind of trades we're looking to place. And then we also have our daily trading summary. So we do this as an overview for what happens in Asia, in Europe, and the US, looking ahead, what kind of trades we might be looking for, more on a narrative base, and then your support resistance zones and so forth, and then any trades that were filled. So we have that proprietary research available to all of our Theta Trader clients. And we'll go back to the dashboard, and I want to jump in and show you the best feature of all. I think it's actually the best feature for Theta Trader, and I think clients would probably agree. So give me just 1 minute and we'll switch gears. And the nice thing is too, when you go to your dashboard, you can see at a glance, just with the color coding, how all your trades are doing. And of course, you could look at your open positions all in one page, or the closed positions in your history here. And then Trade Builder, if you wanted to build your own trade from scratch, you can do that too. But let me switch screens and let's make it easier. This is what I'm probably most excited about, is the trade alert functionality. These are 1 minute alerts, one touch responsive. You simply accept or reject, and that's all you have to do. So these alerts are live, meaning they're integrated with your account. So you touch accept on the screen and the order is placed. Or if you want to reject it, don't want it, you just touch reject. That's all you have to do. Here's what it looks like. You'll receive a text link or an email, and you'll just touch that link. It'll take you right to the alert. And you can see a graph of the alert. You can see the net premium being collected, the cash required. The quantity is already pre-selected for you. Want to point that out. Every alert you receive is customized for you and your account, in the sense that you'll only receive alerts if you don't have a similar trade, but the same or similar strike price or expiration. So these will fill in the gaps, so to speak, in your account. And you'll see here that everything you need to know to be able to make an informed decision is right on that page. And then you just touch accept. And then our technology will then place that order for you. It's just that simple. So people absolutely love those alerts, and they rely on them a lot. And I've never seen anything else like that feature or functionality. So with that said, we're going to jump in and show you how to get involved. We have a special offer for this event for a membership, Theta Trader membership. Of course, it includes everything you just saw with Theta Trader, the Theta Trades, the RTI, the trade simulator. That value is over $3,500 for that software. And then we have those one-touch alerts, which you just saw a brief demo. Again, these are tailored for you and your account, and everything is integrated. You receive that alert and you respond, and our technology handles everything for you. That value over $4,400 for those alerts. So again, you have Theta Trader with the alerts valued at over $8,000. But we also offer you private coaching. Yes, we are not just a technology or fintech or chatbots or anything like that. We're real people with real experience, and you can use that to your advantage. You can work with us, develop that relationship with someone who is licensed and experienced. And I think this value of $7,500 is actually way undervalued. I know people spend $10,000, $25,000, $50,000 for education, for courses, for systems. What we're saying is, with Theta Trader, we provide you what you need, and you get your own coach along the way. So the software, the alerts, the coaching, valued over $15,500. And there's always that corny bonus, right? Just want you to keep in mind, you have that proprietary research, $2,900 value with our trade scope and our daily commentary. And of course, we always include the video tutorials as part of your Theta Trader membership as well. So there's a summary of what you're getting with your Theta Trader membership, valued over $18,500. So it includes everything we've talked about. $29.97, nope. $7.97, nope. In fact, we used to do this at almost $4,000 in live in-person events. So we can do 80% off that retail rate, and it does expire though, but it is one payment of $597. That's your lifetime membership. Great value, $597, one low payment. And there's the special link, cf.altivest.com/TR. That's for timing research. And that's my direct phone number. If you call now, of course, it'll bounce to someone else or go to voicemail because I'm live. But take a screenshot, folks, of this if you don't mind. Or, of course, you can always use the chat room as well. But I know that people sometimes like to call, and I welcome your phone calls if you have comments or questions. And here's the thing, too. 30-day money-back guarantee. So if you don't like what you're seeing after a month, then that's okay. Or maybe something in life changes. We understand. No one's twisting your arm. That's not our business. We've been doing this 30 years. So 30-day money-back guarantee. You have no risk on that membership fee. Get yourself started. Use that link. It's just one simple form. And a few FAQs along the way. Tax efficiency. You can lower your combined tax rate by 10%. Yes, futures and options are tax efficient. So here's an example. If you're trading individual stocks and you have $100,000 with a 20% return, your tax liability is $7,400 if you're in the highest tax bracket, and your rate of return is 12.6%. If you're trading with us and you get those same results, you end up with a tax savings of over $2,000 just because of the tax efficiency. And the reason why is these instruments are treated differently by the IRS. 60% of the gains are taxed at the long-term capital gains rate, which of course is typically less than your individual income tax rate. And there's no more itemizing as well. So that makes it nice and convenient. But please consult your tax attorney or advisor for any details on that. How about an IRA? Yes, there may be some financial or experience requirements, so contact us for details, but people use IRAs. Forbes here says using self-directed IRAs with alternative assets could be something to consider, so we agree. And again, why the E-minis? I talked about that briefly. So they're liquid, they're efficient, and they're cost-effective, and they're huge. The E-mini S&P 500 outtrades all ETFs by over 2.5 times. Let me show you what I mean by that. So the E-mini S&P 500 versus the 6,600 ETFs around the globe is 2.5 times bigger in terms of average daily dollar volume, and almost 10 times larger than the SPY. So if you think all the activity is in the SPY and securities and stocks, it's not. It's on the E-minis. It's the markets we're trading here. volume, liquidity, access, superior execution, cost savings of $4 to $15 per contract, tight bid offer spreads. That's what that means. Execution costs are low. Densely packed strikes, 100 annual expirations. You get granularity and coverage. So this is important. You can see the calls and the puts here, and then the algo for Theta Trader might need to build a new trade. Now it's going to be searching for more calls and puts to buy and sell. And if they don't exist because the volume is too low, then there won't be any trades. But you saw how in our demo there, you can basically choose anything and you're going to have that strike price availability and those expirations available. So that's important. And also with the E-minis, the trades we're doing on the Dragonflies in particular, those 6 different legs, you notice how we placed one order at one price. It's called an object. And if you're doing stock options and you try to do a Dragonfly, you can't do it in one order at one price and at one object. You have to do it in 2 separate orders, and it's very inefficient, and it's a nightmare to manage and follow and track. So that's a big, big advantage. You can't do what we're doing in another landscape. And again, we're tracking just a few, 2 or 3 indexes, efficient margin compared to stocks, and there's a clear cost structure with what we do. It's not opaque. There's no secrets. There's no hidden this or that or the other. Everything trades at the CME group on their Globex electronic exchange. Large, small orders are all treated equally. So that's a big advantage. No payment for order flow. If you don't know what that is, that's Robinhood. That's payment for order flow. Oh yeah, everything's free, but then your execution stinks because there's a big spread. So it's not free, folks. If you're trying to save a penny, but you end up losing a nickel, you know, they're getting fined 65 million bucks. And, you know, actually, I'll show you here in a second, but payment for order flow is disguised commissions. If you want the broker to work for you, pay a commission. I think there's a lot of truth to that. Nothing of value is truly ever free. Something your grandparents would say probably. But that whole payment for order flow model is probably out the window. Gary Gensler, SEC chief, they're going after that model. So that party, I think, is over, thankfully, because it didn't help anybody except those particular firms. It's not to say you can't trade stocks. It's just, it's not free. That's all. Just a misnomer. So what are our rates? Our rates are competitive. They're 5 1/4 round turn all in on the E-minis. Here's a screenshot I took. This is just a little earlier this year. This is a big box brokerage firm, and their rates, they say, are 2 1/4 per contract. And you think, well, that's a lot less than what you're charging, Eric. Well, no, it's not. That's per side. And then they charge clearing and exchange fees on top of that, which they don't show you here. And it ends up being more than what we charge. So our rates are very competitive. And one other comment here about that, it's always net of all trading costs too, everything in Theta Trader. Make sure we don't forget to mention that. Performance of Theta Trader, of course, is different. Everyone uses it differently. And what size of an account? We suggest a minimum 25,000. Now, if you want a free account without that membership fee, people love to take us up on this offer. You have $100,000 or more, then we'll rebate that for you. 50,000 to 99,999, we'll rebate half of that amount for you. So take us up on that offer if that's an appropriate thing for you and your risk capital, and this is the kind of trading you want to get involved in. We'd love to have you take us up on that offer. People use that every time. So what type of accounts? We mentioned IRA, individual joint, any kind of account, we do it just like any other brokerage firm. Again, been doing this, well, 30 years. So we can do all those things. Now, just to kind of wrap it up, why consider Theta Trader? Why non-correlated alternatives in your portfolio? Well, they may improve diversification and lower portfolio risk. And why should that even be a concern of yours? Well, let's look at the landscape. Central bank fueled asset price appreciation. That's what's been going on for about 12, 13, 14 years. Is it coming to an end? Look at this, folks. See any correlation between the S&P 500, which is the red line, and the blue line, which is the total assets of all the global central banks? Well, the Fed, the ECB, and the BOJ. Look at that correlation. It's got to be close to 95%. And here's a little zoomed in view of it. So you know that these central banks are tightening, the Fed's tightening, and you know what's happening to the stock market. Stocks do not like that. So we've kind of had an easy ride, folks. And meanwhile, though, it's created inflation. U.S. consumer prices here, highest since May of 1981. Credit card, everyone's maxing out their credit cards ahead of the recession. Consumer credit numbers are shocking, record highs. Housing payments are way up to almost $2,000 a month compared to $1,200 a month. That's what it looks like in terms of your monthly mortgage payment now. Here's inflation. That's what it looks like here. Energy, food, clothing, 200%, 100, 100, 177, you name it. Everything is through the roof. We know that. Meanwhile, sentiment, consumer sentiment is at a record low down here. Easy to see why. The Atlanta Fed Q2 GDP forecasting 0 growth. So here we are now with the 0 GDP growth. So we're on the edge here of recession/depression territory. So credit card debt all-time high, inflation 40-year high, monthly rent all-time high, gas prices all-time high, stocks starting out with their worst year since 1940. Recession is coming, according to this guy. The Fed always screws up. They're going to be in a bear market. The stocks will be in a bear market by summer. That's from April of this year. So 3 months ago, so I left it here because it looks like he's correct. They're going to keep tightening as the markets go down, and that's exactly what they did. 75 points, the most since what, early 80s was it? So do you believe Powell? And he says there's no sign of a broader slowdown in the economy, or is he just saying what the market wants to hear? But meanwhile, the inflation deniers are finally admitting they're wrong. Janet Yellen saying it's not transitory, even though we all knew it was a year ago. It wasn't. JP Morgan, Jamie Dimon, Goldman Sachs, World Bank, IMF, on and on and on, looking at food shortages. So there's a lot going on, folks. Recession, getting close to 80% probability for recession by Q1 of next year. Mean reversions. This is interesting here. So you can see this is the inflation adjusted S&P 500 index right here. And you can see throughout history, when it gets this much becomes this much of an outlier, it's always going to mean revert back to its exponential growth trend. So we've got a long way to go. Could be that stagflation is creating a lost decade for that 60-40 portfolio. So if you're doing the same old thing, I don't know, it's getting beat up even this year. You see bonds, yields going up, bonds going down, stocks going down. Next 10 years don't look so good according to this indicator. It's called R-squared statistic, predicting 70% of the changes in the stock market's 10-year return. And right now it's suggesting the next 10 years, the S&P will be minus 4.2% annualized in the next decade. So something to consider, folks. This landscape probably not ripe for just being passive and sticking with a long-only approach. We like the alternatives. Keep in mind, stock market can be sideways for decades at a time. You may end up just being passively invested, and 20 years later, ending up in the same spot. In fact, with inflation, you'd be negative. So avoid those big drawdowns. This is math, simple math, and I know it's kind of stating the obvious, but you're down 40%, and you have to generate a 67% return just to break even. So avoid those drawdowns. Look at the poor Bitcoin people, down 70%. So now you have to be up 233% to get back to even. So avoid those big drawdowns. Don't just be passively long and sitting there. Even, money managers will always be long. They'll never tell you to sell because they want to keep your assets with them. But if that's what you want to do, that's okay. But there's some risk in doing that, folks. So we like the alternative sector, which is what we do. So take some of your portfolio, allocate it into the alternatives. And you can see here, Theta Trader membership allows you access to something unique, non-directional and directional both. We use automation to make it simple and easy for you with those trade alerts and the coaching. Simple steps here to get involved. You just complete that order form, and then we'll get you started. I'll leave this slide up here, and I think I have probably I haven't had a chance to see everything, but Let's take a look here. There's a few more questions. Yeah, we covered the trading cost already. Thanks for asking. And you want to know about the trade alerts and so forth. Yeah, you can give us a call. We can tell you about some of the details and the history on those. And another question we always get is, I'm in Canada. Can I have an account with you? We had a guy in India. We've had a guy in Australia, had a guy yesterday in the EU. So it just depends where you're located. There are regulations and so forth out of our hands, out of our control, that kind of determine that type of thing. So just call me, 236-6961. You see the phone number here. You can email as well, info@altivest.com. I'll see that. It'll get to me, or Erik, ERIK, @altivest.com. But yeah, it's a great deal. The membership, it expires here, that discount Friday, so it gives you some time if you have any other comments or questions. And let's see if there's any other questions. Oh, sometimes people will suggest that they have a brokerage account and they want to use Theta Trader. And it doesn't really work like that because Theta Trader is integrated with us. We are the brokerage firm. So you simply have an account with us, just like you would with any other brokerage firm. And you become a Theta Trader member, and you're able to use all the technology in our service and so forth. And someone's asking about what types of returns can be expected. Well, briefly, the answer is, if you notice on Theta Trader, each one of the trades, like your typical Condor or Dragonfly, you're going to be targeting a return depending on the market conditions. You know, I'd say maybe somewhere around 30% is kind of your target. But of course, market conditions can determine that. It might be a little bit less at times. So hopefully that answers what the target rate is on that. All right, and yeah, and the commissions are 5.25 per option. That's correct. And again, everything is net of all commission. So all the results, the dollars, the percentages, and everything is net of all trading cost. And oh yeah, there's no monthly fee or anything. It's just a one-time $5.97, one low payment. That's it. Then you're a lifetime member. And again, we've been doing this for many, many years, so we're not going anywhere. All right, I think that'll wrap it up. I don't want to go over my time limit here. And thank you for joining us, and I'm glad to be here. But I do invite you to call me, and that's my number there. And if you had any other thoughts or comments or questions, I'd love to hear from you.